Here is a fear that stops a lot of Canadians from investing a lump sum, or even continuing their regular contributions at a specific, very common moment. The market has just hit a new all-time high, and it feels like exactly the wrong time to buy, because surely, right after a record high, a crash, or at least a meaningful pullback must be coming. This feeling is completely understandable. It is also, according to one of the more counterintuitive and well-documented findings in long-run market research, not actually supported by the historical data. Here is the specific question this video answers. If a hypothetical investor had only ever invested money on days when the market closed at a brand new all-time high, never on an ordinary day, never during a dip, only at the exact moment the market reached a level it had never reached before, how would that investor's results compare to an investor who invested on any random day, or even an investor who specifically waited for a meaningful pullback before buying? The well-documented, repeatedly replicated answer surprises most people the first time they see it. An investor who only bought at new all-time highs has not historically performed meaningfully worse over long time horizons than an investor who bought on any random day and in some specific comparisons has performed about the same or even somewhat better. This finding is not a prediction that markets always go up, and it is not a guarantee about what happens after any specific future high. It is a structural, settled fact about how markets have actually behaved historically, and the reason behind it, covered in the very next segment, has to do with a specific, surprisingly high percentage of all trading days in market history that you are almost certainly underestimating right now. Here is the vault from the opening. The specific reason the market just hit an all-time high sounds rare and alarming, when historically it has actually been a routine, frequent feature of how a long-term rising market behaves. The core statistical finding across the long-run history of broad market indices like the S&P 500, research examining decades of daily trading data has consistently found that a meaningfully large share of all trading days, commonly cited in the broad range of 5% to 7% of all trading days across multi-decade periods, and considerably higher in some specific strong bull market stretches, have actually been new all-time closing highs. This is a far higher percentage than most people intuitively guess, because the framing all-time high sounds, by its very name, like it should describe a rare, exceptional occurrence, when in long-run statistical terms, for a market with a positive long-term trend, it is mathematically almost the opposite of rare. Why this makes logical sense once you think through the mechanism. A market that has a positive long-run average return, by definition, must spend a substantial portion of its time setting new highs, simply to be able to deliver that positive long-run average return at all. A market that only set a new high once every few years and spent the rest of its time below previous peaks would, by definition, not be exhibiting the kind of steady, long-run upward trend that broad equity markets have historically displayed. New highs are not an aberration within a rising trend. They are the literal definition of what a rising trend looks like, measured day by day. Why this reframes the entire fear from the opening. If new all-time highs are a routine, recurring feature of long-run market behavior rather than a rare warning sign, then the market is at an all-time high, carries far less specific, useful predictive information than it intuitively feels like it should. Because if you adopted a strict personal rule of never invest at a new all-time high, you would, given how frequently new highs occur within a rising market, be disqualifying yourself from investing during a meaningful share of all the days a long-term rising market actually offers, including, very plausibly, during some of the market's best multi-year stretches, which are often punctuated by frequent new highs, precisely because the underlying trend during those stretches is strongly positive. a clarifying distinction worth making explicitly. This finding describes the behavior of broad, diversified market indices over long, multi-decade periods specifically. It is not a claim about every individual stock, every specific market, or every specific multi-year window without exception. And it does not mean that prolonged periods without new highs, such as following a severe bear market, when it can take years to reclaim a previous peak, do not also occur in market history, because they certainly have. Your action step. The next time you hear a news headline describing the market hits a new all-time high, as if this were inherently noteworthy or alarming, recall that, statistically, new highs have historically been a routine and frequent occurrence within a long-term rising market. And ask whether the headline is providing genuinely new, useful information or simply describing the ordinary day-to-day texture of how a rising market behaves. Here is the specific comparative research behind the claim from the opening, illustrated using standard, conservative, widely cited methodology applied to long-run market history. The research methodology, explained simply. Researchers studying this question have typically taken two hypothetical investors. Investor A, who invests a fixed amount of money only on days the market closes at a brand new all-time high, and Investor B, who invests the identical fixed amount on entirely random days, regardless of whether the market is at a high, in a dip, or anywhere in between. Both investors' subsequent returns are then tracked forward over various time horizons, 1 month later, 1 year later, 3 years later, 5 years later, and the results are averaged across every instance of a new high, or every random day, across the full multi-decade period studied. The well-documented, repeatedly replicated finding across multiple independent studies examining this question using different time periods and slightly different methodologies, the forward returns following an investment made at a new all-time high have, on average, been comparable to, and in some specific studies, modestly better than, the forward returns following an investment made on a randomly selected day. This finding has held up across 1 year, 3-year, and 5-year forward return windows in the research that has examined this question. Why this finding, while counterintuitive on first hearing, is consistent with the mechanism explained in Segment 1. If new highs are simply a routine, frequent feature of a market with a positive long-run trend, as established in Segment 1, then investing specifically at a new high is, in a meaningful statistical sense, simply investing during a period when the underlying trend has recently been positive, and a market trending positively, on average, has historically tended to continue trending positively over subsequent multi-year periods more often than it has reversed sharply, a separate but related, well-documented tendency, sometimes referred to as positive momentum, at the broad index level over multi-year horizons, a more modest, secondary effect, distinct from the primary finding being discussed in this segment. The crucial distinction this is not claiming. This research is not claiming that buying at a new high guarantees a good outcome, that markets cannot decline meaningfully after reaching a new high. They certainly can, and historically have, on numerous occasions, or that this finding can be used to time entries with any precision. It is making the narrower, well-evidenced claim that the simple fact of a market being at a new all-time high, by itself, has not historically been a reliable signal that meaningfully worse than average forward returns are specifically more likely from that point than from any other randomly chosen point. A useful, concrete illustration of the underlying logic. Consider that a broad market index reaching $100 for the first time, then later reaching $150 for the first time, then later still reaching $200 for the first time, has set 3 separate new all-time highs along a single continuous upward path. And an investor, who specifically avoided investing at each of those three specific milestone points, while remaining happy to invest at $120 between the first two highs or $175 between the second and third, was making a fundamentally arbitrary distinction between price points that were, in the broader context of the index's overall upward trajectory, simply different positions along the same generally rising path. Your action step: if you find yourself specifically avoiding an automated recurring investment contribution, the dollar-cost averaging approach covered in this channel's dedicated video on time in market versus timing the market. Purely because the market happens to be at a new high on that particular contribution date, recognize that this specific avoidance is not supported by the historical research on this exact question, and consider whether you are introducing a market timing decision into a system that was specifically designed to remove timing decisions in the first place. If buying at new highs has not historically been the dangerous decision it intuitively feels like, the natural follow-up strategy many investors consider is the opposite: deliberately waiting for a meaningful pullback or dip before investing a lump sum of available cash. Here is why this specific strategy, while intuitively appealing, carries its own well-documented set of problems. Problem 1. You cannot reliably know in advance how large a meaningful dip will be, or when it will end. An investor waiting for a 10% pullback before investing faces an immediate practical problem. If the market falls 5% and then resumes climbing without ever reaching the 10% threshold, the waiting investor has missed the entire intervening period of gains while waiting for a decline that never fully materialized. And this is not a hypothetical edge case, but a routinely observed pattern. Since markets do not decline in a smooth, predictable, threshold-respecting way. Problem 2. Cash sitting on the sidelines waiting for a dip earns minimal or no return during the entire waiting period. Every month spent waiting for a specific entry point is a month during which the waiting capital is not participating in any dividends, any compounding, or any price appreciation that may occur during the wait. A direct, calculable opportunity cost that accumulates the longer the wait extends, and one that can quietly offset or exceed whatever theoretical benefit might come from eventually buying at a lower price, particularly if the anticipated dip is modest or short-lived relative to the length of the wait. Problem 3. Even when a meaningful dip does eventually occur, the same psychological barriers covered in this channel's other videos on market timing and behavioral finance frequently prevent investors from actually buying during the decline itself. A dip, by its nature, occurs alongside negative news, declining sentiment, and a generally uncomfortable emotional environment. Precisely the conditions under which the loss aversion and recency bias mechanisms covered in this channel's Time in the Market Beats Timing the Market video make it psychologically difficult to actually execute a purchase, even for an investor who had specifically been waiting for exactly this moment. The investor frequently ends up waiting for the dip to clearly end and a recovery to begin feeling more certain, at which point a meaningful share of the recovery's gains, including potentially some of the disproportionately powerful single days covered in this channel's other research on missed days statistics, has often already occurred. The mathematical reframe this produces: when researchers have specifically compared a hypothetical investor who invests immediately upon having available cash, regardless of whether the market happens to be at a high, a low, or anywhere in between, against an investor who waits for a specific pullback threshold before investing that same cash, the immediate investor has, across most historical periods studied, come out ahead, not because waiting for a dip is a foolish idea in the abstract, but because the combined cost of the cash sitting idle, the practical uncertainty about whether and when a sufficient dip will occur, and the well-documented psychological difficulty of actually buying during one when it arrives, together tend to outweigh the benefit of the lower entry price the strategy is specifically designed to capture. The important caveat this segment does not erase. None of this means dollar-cost averaging, investing on a fixed schedule, regardless of market level, covered extensively elsewhere on this channel, is inferior to investing a lump sum immediately. That is a separate related question with its own nuanced research, distinct from the specific wait for a dip before investing available cash strategy discussed in this segment. What this segment specifically addresses is the strategy of deliberately delaying an investment once the decision to invest has already been made and the cash is already available, purely in pursuit of a better entry price. Your action step: if you currently have investable cash that you have specifically been holding back, waiting for a pullback before investing it, calculate explicitly how long you have been waiting and what that cash would be worth today, including dividends, had you invested it on the day you first decided to wait. A concrete number that frequently makes the actual cost of waiting considerably more vivid than the abstract intention to wait for a better price. Here is what this entire body of research means practically for how a Canadian investor should actually approach the decision of when to invest, distilled into a few clear, durable principles. Principle 1. Stop treating "the market is at a new high" as meaningful, actionable information on its own. Given the finding from segments 1 and 2 that new highs are routine and frequent within a rising market, and that forward returns following a new high have not historically been meaningfully worse than forward returns following a random day. The simple fact of a new high, by itself, does not constitute a useful signal for delaying or accelerating an investment decision. If you have a regular scheduled contribution or a lump sum you have already decided to invest, the market being at a new high on that specific day is not, on its own, a reason to deviate from your plan. Principle 2. If you have available cash you have decided to invest, the research on waiting for a dip, segment 3, suggests that investing it promptly, rather than waiting for a specific pullback, has historically tended to produce better outcomes across most periods studied. Though this is distinct from the separate question of whether to invest it all at once or spread it across several months, which depends partly on individual risk tolerance and is covered in more depth in other dedicated content. Principle 3. The most durable evergreen solution to both the new high anxiety and the wait for a dip trap is the same one covered in this channel's dedicated video on time in market versus timing the market. Automate the decision entirely. A recurring automated contribution into a diversified low-cost equity ETF, such as XEQT or VFV, held inside a TFSA or RRSP, scheduled on a fixed date regardless of where the market happens to be sitting on that date, at a new high, in the middle of a dip, or anywhere in between, sidesteps the entire question this video has examined, because the contribution happens automatically, without requiring a fresh judgment call about whether now is specifically a good or bad moment based on proximity to a recent high or low. Principle 4. Reserve genuine analytical attention for the questions that actually matter, rather than the question this video has shown does not. Your savings rate, covered in this channel's dedicated video on why how much you save matters more than how much you make. Your overall diversification, covered in this channel's video on diversification as the only free lunch in investing. Your account selection between TFSA and RRSP and your time horizon are all genuinely consequential variables you can meaningfully influence and that have a real, demonstrated effect on your long-run outcome. Whether the market happens to be at a new high on the specific day you make a contribution is not one of them. based on the historical evidence covered in this video. The honest, necessary final caveat. Everything in this video describes historical patterns over long periods, not guarantees about the future. Future market behavior could, in principle, differ from the historical pattern described, and a severe future downturn could begin at, near, or shortly after any specific all-time high, including one you personally invest at. The finding in this video is about the historical balance of probabilities across many decades and many specific instances of new highs, not a guarantee about any single specific instance. Your action step. If you currently have an automated recurring investment contribution set up, do nothing differently in response to market headlines about new highs or recent dips. Let the existing automation continue exactly as designed. If you do not yet have one set up, this is the moment to establish it, specifically because doing so removes the entire question this video has examined from your future decision-making permanently. Let's come back to where we started. The market just hit a new all-time high, and it feels like exactly the wrong time to invest, because surely a crash or a meaningful pullback must be coming right after a record level. You now understand why this intuitive fear, while completely understandable, has not historically been supported by the data. New all-time highs have been a routine, frequent feature of long-run rising markets, occurring on a meaningfully large share of all trading days across multi-decade history. Precisely because a market with a positive long-term trend must, by definition, spend a substantial portion of its time setting new highs to deliver that trend at all. And when researchers have specifically compared forward returns following an investment made at a new high against forward returns following an investment made on any random day, the two have historically been comparable, not meaningfully different in the way the intuitive fear would predict. The opposite strategy, deliberately waiting for a pullback before investing available cash, carries its own well-documented set of problems. The difficulty of knowing in advance how large a dip will be, or when it will end, the real opportunity cost of cash sitting idle during the wait, and the same psychological barriers that make market timing difficult in general, which frequently prevent investors from actually buying during the exact decline they had been waiting for. None of this guarantees what happens after any specific future high, including whichever one prompted you to watch this video. What it does provide is a well-evidenced, historically grounded reason to stop treating "the market is at a new high" as a meaningful signal on its own, and to redirect your attention toward the variables that have actually, demonstrably mattered. Your savings rate, your diversification, your account selection, and simply staying invested, on schedule, regardless of what any single day's headline happens to say.